Hello and welcome back to the Girard Realty Show. It's Damian Girard, your host here, Sunday at 3 o'clock and every Sunday at 3 o'clock. And as promised earlier, we are going to talk with Mr. Mike Mudry from USA Mortgage. We're going to do the Mudry Mortgage Minute segment.
3M.
The Triple M. Mm-hmm. So, Mike, what is going on in the mortgage world? We see rates starting to kind of jump up a little bit. You know, they were down a few months ago. Now they're coming up. But you can't talk about specific rates, right? We can't tell somebody your rate's going to be 3.25.
That's right.
We don't know.
We don't know at this point, right?
A lot of factors involved on what someone is going to get quoted. So there's like normal rates. I can say rates. I can say that 30-year money today is about 3 3/4, 3.75.
Pretty close.
Because I'm not a mortgage guy.
That's right.
That's what we have you for. But you can't say it, or you would go to mortgage prison.
I hope not.
So, but you know, the question on everybody's mind is, depending on how old they are, where's it going, right? Yeah. Because the true cost, and Alfonso, you talk to your clients about this all the time, mm-hmm. the true cost of owning a house is not just what you pay for the house, right?
Absolutely right. Yeah.
Within a few $1,000s, the price that you pay for the house doesn't have that big an impact. The true cost of home ownership is the interest that you're going to pay, right? Because that is what determines how much you're going to have to pay on a monthly basis just for the interest rate. So you got principal and interest and taxes and insurance. We're going to talk about insurance a little later today. But so, Mike, in general, where do you think rates are going? I mean, they're 10-year low, 12-year low?
Yeah, something? They're near. You know, they're still very, very good historically. They're not at a 10-year low, but they're near it probably. So,
yep.
You know, earlier this year, we were having the same conversation. It looked like rates were going to go up. Everybody was predicting that.
We have it all the time.
And then they went down.
Right. We always say, oh, you better get in right now because rates are, you know, it's impossible they can stay this low.
And then they started to creep up a little bit, and then they went back down, you know. So it's really, really hard to predict. But, you know, many of the so-called experts are predicting that we'll see higher rates because we have had a long period of low rates for quite some time.
Right. For 3 or 4 years.
So, you know, the law of averages would say at some point in time they are definitely going to go higher. When I started in the industry in 1992, interest rates were about 6.5%, 7%, somewhere around there. And
I
those
remember
were great rates back then.
That was what I was going to say.
That's actually more the norm, isn't it, Mike?
Yeah,
I mean,
historically.
I bought my first house in 1982, and my interest rate was 11.5. You know, and I remember when they got into single digits, that was like, you know, a whole new world just opened up, right?
So part of the problem we have today is that we've had these low rates for so long, everybody thinks it's the norm.
Right.
And
well, especially Krista, our millennial representative of young people. I mean, you think that 3.75 is probably high because a year or two ago it was 3.5. Right? So it's perspective.
And we've seen all kinds of car loans, 0% financing for this, and we've just had this on our brains for so long that these rates are just going to stay this way, and they're not.
They're not.
You know, I don't know when they're going to go up, how high they're going to go up, but I do know that they're still good. It's still a great time to buy a house. The affordability is still tremendous.
Right, and affordability is the key. The key. I mean, that's what it really comes down to. And again, it's part of our weird market that we're in. You know, since the crash of 2007 really stopped, the market stopped going up, hit a brick wall in June of 2006, and then in January of 2007, it fell off the cliff. Yeah, and it broke all the rules. You know, it used to be if rates went down, house prices went up. That doesn't happen anymore, right? It used to be that housing kind of ticked up in St. Louis market. If you look at a 100-year curve, housing has gone up about 4%, 3.5%, 4%, you know, over time.
Per year.
When the rest of the world would go up and down and up and down, St. Louis just never, we stopped going up, but we never really pulled back, right? And then in 07, 08, boom, things crashed. It just, we went down overall almost 18%.
Yeah, you know, there's just so many things that affect the interest rate market. You know, I mean, the people at the Federal Reserve, you know, we've had all these famous chairmen from Bernanke to Greenspan to now Janet Yellen, and they go to lunch and they have a conversation and they're having a meeting and the bond market freaks out and rates go up on any given day.
Right.
And then the next day you have something happen in the Middle East and the bond market reverses and money floods into the U.S. and rates go down. So there's so many factors that influence what direction those are going to go.
But,
and again, the bottom line is nobody can control any of that stuff.
And nobody knows where it's going.
Nobody really knows. You just have to take advantage of the opportunity that presents itself to you today.
And we always have to bring back these broad conversations to something useful for our clients and our listeners, right? So to me, the message in this is, and I'm going to back up a little bit and say, real estate transactions are generally a result of a change in someone's lifestyle, sure. Right? You need a bigger house because your kids moved out, or because you just are having kids. You need a smaller house because they just moved out. You need a condo because you just got divorced.
Or a new job for relocation.
A new job. Yeah. I mean, we do real estate around a life event, mm-hmm. right? And that's unpredictable, right?
Yeah.
Nobody ever, I'm going to be in this house for 15 years.
Heard that a million times.
Okay.
Rarely happens.
No, you're not. You don't know what's going to happen in 2 years or 3 years. You might decide to take a job in the south of France. But knowing that it's completely unpredictable, really, when a real estate transaction is going to come into your life, I mean, you can plan for it, but it's unpredictable.
Mm-hmm.
The right time to be in a real estate transaction is when you feel that it's the time. And if you feel like this is the time, it's impossible to know if next year is going to be better or worse. My personal opinion, and you guys can disagree if you like, house prices are not going backwards for a number of years, and interest rates are not getting lower for a couple of years. So if you are going to be in the market anytime in the next couple of years, when should you do it?
Right now.
Right now.
Now's the time.
Now is the time.
It really is. So that was a kind of a loose conversation, but again, we have to address, and we get a lot of questions from our clients and from listeners about this, timing. When do I do it? When do I do it? What's the maximum time? And our answer always is now, if that's what you feel like doing. But when you look at the costs involved and what's happening in the marketplace, home prices going up, interest rates going up. We don't know when, but they're not going backwards for a while. We're at the low of a new cycle. So anyway, there you go. That's a great conversation. Loose, but great conversation. That's good radio, Mike.
I agree.
And no one-word answers from you today.
No, never.